In 1969, a 41-year-old wildcatter from the Texas Panhandle named Boone Pickens looked at a small Kansas natural gas company called Hugoton Production and concluded that its underlying gas reserves were worth substantially more than the market value the company's stock implied. He approached Hugoton with a takeover proposal. Hugoton was approximately 30 times the size of Mesa Petroleum, the company Pickens controlled. The mismatch in scale would have been disqualifying for most independent oil operators. For Pickens, the asymmetry between the size of his company and the value he saw in Hugoton's reserves was an opportunity rather than a barrier. The Hugoton takeover succeeded. The transaction roughly doubled Mesa's reserves and established Pickens as one of the most analytically sophisticated independent oil operators in the United States. More importantly, it established the operational template Pickens would deploy across the next 2 decades. Identify a target company whose underlying asset value substantially exceeded its market capitalization. Build a position aggressively. Use shareholder rights to force either a friendly transaction at a substantial premium or a hostile takeover at full asset value. Exit at the higher valuation and redeploy the capital into the next undervalued target. The 1980s would test the template at scale. Pickens launched takeover bids against Cities Service, Gulf Oil, Phillips Petroleum, and Unocal, among others. The Gulf Oil campaign of 1983 produced a profit of more than $750 million when Gulf was eventually acquired by Standard Oil of California. The Time magazine cover of March 1985, taken during the Gulf takeover, established Pickens as the most recognizable face of 1980s corporate rating alongside Carl Icahn. What followed across the next 30 years was one of the more remarkable second and third acts in American business history. Forced out of Mesa Petroleum in 1996 at the age of 68, with his fortune diminished and his health beginning to show the strain of 50 years of aggressive operation, Pickens founded BP Capital Management in 1997 as an energy-focused hedge fund. The hedge fund produced returns through the 2000s commodity supercycle that exceeded almost any of his earlier achievements. In 2005, his combined income from BP Capital was approximately $1.5 billion. In 2007, the figure was $2.7 billion. This is the story of T. Boone Pickens, the founder of Mesa Petroleum and BP Capital, and what his career means for working traders. Thomas Boone Pickens, Jr. was born on May 22, 1928, in Holdenville, Oklahoma. His father, Thomas Boone Pickens, Sr., was an oil and mineral landman, the person responsible for negotiating leases for petroleum exploration rights with rural landowners. The household was modest in scale, but intellectually engaged with the oil industry from the beginning of Pickens's life. His mother, Grace Markeline Mollinson Pickens, ran the local office of price administration during World War II, rationing gasoline and other goods across 3 Oklahoma counties. The wartime administrative role gave the household direct exposure to the operational complexity of regional resource allocation. She taught him fiscal discipline. She also modeled, from an early age, the proposition that a Holdenville woman could operate consequentially within complex regulatory systems if she understood the underlying mechanics. The family moved to Amarillo in the Texas Panhandle when Pickens was in high school. He graduated from Amarillo High School and enrolled at Texas A&M University on a basketball scholarship in 1945. The basketball scholarship was lost when Pickens broke his elbow during a game, and he transferred to Oklahoma A&M College, now Oklahoma State University. He majored in geology and graduated in 1951 with a Bachelor of Science in Geology. After graduation, Pickens took a position as a well site geologist at Phillips Petroleum, where his father had worked as a lawyer. The Phillips experience was professionally formative for 2 reasons. First, It gave Pickens detailed exposure to the operational mechanics of large integrated oil company petroleum exploration. Second, it gave him a direct view of what Pickens later described as the waste and inefficiency that he believed plagued large oil companies. Pickens left Phillips in 1954 and spent 2 years as a freelance consultant to wildcatters. He charged $75 per day for his consulting services. He lived out of his car. He learned the operational mechanics of independent oil production from the inside, in a way that the Phillips employment had not provided. In 1956, Pickens scraped together enough capital to found Petroleum Exploration, the company that would later become Mesa Petroleum. The starting capital was approximately $2,500 in cash, plus $100,000 in borrowed money. He took the company public in 1964 under the Mesa Petroleum name. The 1969 takeover of Hugoton production established the operational template Pickens would deploy across the next 25 years. Hugoton was a Kansas-based natural gas producer with substantial reserves in the Hugoton gas field. The company was approximately 30 times the size of Mesa Petroleum by market capitalization. Pickens's analysis indicated that Hugoton's underlying gas reserves were substantially more valuable than the market price of its stock implied. The structural insight underneath the Hugoton takeover would become the foundation of Pickens's subsequent career. Markets systematically undervalue oil and gas companies whose management is not deploying the underlying reserves productively. The gap between the market value of the equity and the underlying asset value of the reserves can be substantial and persistent. The activist investor who can identify the gap, build a position large enough to force change, and then deploy the underlying assets more productively can capture the gap. The 1980s were the most aggressive and consequential period of Pickens's career. The decade combined 3 structural conditions that were unusually favorable for energy-focused activist investing. First, the integrated oil companies of the 1970s had developed conglomerate structures with substantial hidden reserves value. Second, the development of high-yield debt markets through Drexel Burnham Lambert and Michael Milken gave activist investors access to financing for hostile takeovers at unprecedented scale. Third, the regulatory environment under the Reagan administration was relatively permissive of hostile takeovers. Gulf Oil in 1983 was the most consequential. Pickens led an investor group that built a 13% position in Gulf and pressured the company toward restructuring or sale. The campaign ultimately produced a defensive sale of Gulf to Standard Oil of California in early 1984 for approximately $13.2 billion, then the largest corporate acquisition in American history. Gulf Investment Group netted more than $750 million in profits from the campaign. The 1985 Time magazine cover, published during the Gulf takeover battle, established Pickens as the most recognizable face of 1980s corporate rating in the energy sector. The campaigns continued through the mid and late 1980s, with bids on Phillips Petroleum, Unocal, and Newmont Mining, none of which produced control of the target companies, but most of which produced substantial profits when Pickens exited his positions at premium prices. The mid-1990s were the most difficult period of Pickens's career. Natural gas prices declined through the early 1990s. Mesa Petroleum had loaded substantial debt during the 1980s campaigns. By 1996, the company was carrying approximately $1.2 billion in debt, and Mesa itself had become a target of corporate raiders. Pickens blocked a takeover attempt by arranging for Richard Rainwater, the former Bass family financial executive, to invest as much as $265 million on preferential terms. The arrangement was intended to preserve Pickens's role as Mesa's operational head. The arrangement did not work out as Pickens had intended. In May 1996, Rainwater invited Pickens to his Santa Barbara estate, and arranged a meeting that effectively communicated to Pickens that he would be removed from his role at Mesa. The removal was finalized later that year. Pickens was 68 years old and had built Mesa from a $5,000 starting capital base over 40 years. BP Capital Management was founded in 1997, the year after Pickens was forced out of Mesa. The BP stood for Boone Pickens, not for British Petroleum. The fund was structured as an energy-focused hedge fund, taking positions in the equities and commodities of oil, natural gas, and related sectors. The early years of the fund were unprofitable. Pickens has subsequently described the period as one of the most difficult of his life, both professionally and personally. The commodity supercycle that began in the early 2000s and accelerated through 2005 to 2007 transformed BP Capital from a struggling boutique into one of the most consequential energy-focused hedge funds in the world. Pickens's analysis of long-term oil supply constraints proved increasingly accurate as Chinese demand growth, declining production from mature North American basins, and accelerating geopolitical tensions drove energy prices substantially higher. The 2005 financial year produced returns that vindicated Pickens's framework on the largest scale of his career. BP Capital's hedge fund was up approximately $1.3 billion, and a second BP Capital fund that invested in energy company equities was up approximately $532 million. At the Christmas luncheon that year, Pickens distributed $50 million in bonus checks to BP Capital employees. His combined income for 2005, including investment returns and fees, was approximately $1.5 billion, on which he paid approximately $279 million in taxes. The 2007 results were even more spectacular. The BP Capital Equity Fund grew by 24% after fees. The $590 million Capital Commodity Fund grew by 40%, primarily through positions in Suncor Energy, ExxonMobil, and Occidental Petroleum. Pickens's combined income for 2007 was approximately $2.7 billion. The halftime he had described after his Mesa exit had produced returns substantially exceeding what he had built across the entire 40-year Mesa era. In 2008, at the age of 80, Pickens launched the Pickens Plan, a public advocacy campaign for American energy independence. The plan combined natural gas as a transportation fuel, large-scale wind power development across the U.S. Great Plains, and various other measures to reduce American dependence on imported oil. Pickens spent approximately $100 million of his own money funding the campaign through television advertising, public appearances, and policy advocacy with both political parties. Pickens's career rests on a small number of structural insights. Markets systematically undervalue companies with poor capital deployment. The most reliable source of mispricing in oil and gas equities is the gap between the underlying value of reserves and the market value of the equity, created when management is not deploying the reserves productively. Operational expertise creates analytical edge. Pickens's edge against generalist activist investors was that he understood the underlying oil and gas reserves at a geological level. He could evaluate the productivity of a given field more accurately than financial analysts who were not geologists. Reserves are structural patience. Pickens's most consequential discipline was the willingness to hold positions through extended takeover battles, even when individual quarters or years produced apparent setbacks. The takeovers required years of sustained pressure to produce results. Reinvention is structural option value. The Pickens career arc, from Mesa to BP Capital to the Pickens Plan, demonstrates the structural value of being willing to reinvent the operational framework when the underlying conditions change. Pickens suffered a series of strokes beginning in 2016 and a serious fall in 2017 that required hospitalization. In January 2018, BP Capital Management closed to outside investors, with Pickens citing his declining health. The fund had been operating for 21 years. He died on September 11, 2019, at the age of 91. At the time of his death, his net worth had declined to approximately $500 million, after he had given away more than $1 billion to philanthropic causes during his lifetime. What Pickens means for working traders maps onto mind, method, money. Mind. Develop the temperamental capacity to operate on long-term thesis rather than short-term price action. Pickens's most consequential campaigns took years to play out. The investor who needed quarterly validation could not have operated within his framework. Method. Build operational understanding deep enough to identify mispricings the market has missed. Pickens operated almost exclusively in oil and gas, where his geological training gave him analytical edge. He did not deploy capital aggressively into industries where he did not have operational understanding. Money. Maintain the structural capacity to deploy capital aggressively when opportunities emerge. The 2005 to 2007 commodity supercycle produced opportunities that Pickens could deploy BP Capital's resources against because the fund had built the analytical infrastructure and the capital base to act when the opportunity emerged. The most underappreciated feature of Pickens's career may be the consistency of the framework across the 6-decade arc. The geological analysis he learned at Oklahoma A&M in the late 1940s and applied at Phillips Petroleum in the early 1950s was, in its essential elements, the same framework he applied through the Mesa era, the BP Capital era, and the Pickens Plan advocacy. The underlying analytical framework, deep operational understanding combined with the willingness to deploy capital where the analysis supported the deployment, remained unchanged. In his own words, quote, "For most people, that would have been the end. For me, it was halftime." That was T. Boone Pickens. This was episode 29 of The Greatest Traders. I'm your host. Thank you for listening.